At the end, we have about 20 minutes or so for open discussion. I'm going to ask that Institute staff hold off a bit and let some of our guests ask questions or make comments before we turn it over to our always eloquent staff. There's a mic in back. There's also a traveling mic. Please identify yourself if you want to say something. And if nobody does, then we will ask Institute staff.
Adam, since you asked me to lead off, I think I will.
This is Tom Honig of the
Federal
Vice Chairman of the
Deposit
FDIC.
First of all, let me just say I truly enjoyed the book. I did get the preview, and I wanted to compliment both Anat and Martin for the great job. Second thing is, I do agree. I think, in terms of the causes, I think one of the huge issues we have is the subsidy, specific in the United States, but I think also very explicit throughout the world, which I think is distorting the market. I would also share the observation that you can have high capital, and in fact, the banks, some of the largest banks today who have the higher capital levels in terms of real capital are trading at premiums to book, while the highly leveraged are trading at discounts. But finally, I do have a question. It's more for Peter, because I've heard you say before, in a sense, that the problem is that we're overbanked. I think the problem is that we're over-subsidized, because when you subsidize something, you increase the supply dramatically, which is what we've done. And if you had stronger capital, I think you could have more banks, but they would be smaller. And I think it's Adam Smith's preference that you have more banks with good capital so that your systemic risk to a single point of failure is less. So how do you think about that?
Well, if we can imagine some future equilibrium, I think I'm going to agree with you. If you imagine the transition from where we are, both in Europe and the United States, I'm afraid we still have this dilemma. How do we get more capital into a system that looks like it could do with some shrinkage? The fact that the FDIC, maybe not every Friday, but many Fridays of the year, are shuttering a handful of banks tells me something about the capacity. I'm nervous about how much earnings power the banking system in the North Atlantic has, and that if we don't get back to that trend rate of growth that everyone keeps expecting, I think I'm going to be right in the short run that there are not enough earnings to go around, and there may be another leg of consolidation to come. But in an optimal sense in the long run, I think I agree with you. If we got the subsidy out, we'd be quicker at finding what the equilibrium number of bank balance sheets is.
And now, sorry, you wanted to follow?
Yeah. I agree, and I think this is where the Swedish example contains a lesson. Intervene right away, reorganize, and reprivatize good banks. One problem that we've had in the crisis is we haven't adjusted market structure. We've worked, in Europe, governments have intervened, allowing banks to farm out their toxic assets into bad banks. And those bad banks are hanging over the government or maybe the banks, but there has been no adjustment of market structure except for the fact that the European Commission has imposed some control. So we don't know how many skeletons there are still around, and we can be reasonably sure that margins are going to be just as small in the future as they've been in the past. If you talk to someone like Stefan Ingves, who was in charge of this in Sweden in '92, he'll say, well, winding down market structure and reprivatizing, the only way you get the market to pay a price for this is if they anticipate that they will earn profits. So there, it was part of the incentive structure of the intervening government to make sure that some closing down would happen. Now this again links up with the point, when is the time right? And here I'd say the experience shows that the damage for real growth and the damage for the economy from not intervening and just letting zombies or semi-zombies or merely distressed banks continue and sort of toddle along may be greater, even though immediately it may, in the immediate future, it may seem less painful. But this is why I'm very worried that we have not really cleaned up the mess after the crisis.
Thank you. I don't want this to become a ping pong match, but if David, do you want to come in on this or do you want to skip?
Yeah, well, obviously, those are all serious concerns. I think if you speak to Stefan Ingves, he'll also tell you that it's necessary and important to phase in the Basel program, both capital and liquidity, on more or less the schedule originally anticipated. There were some explicit statements of that in the recent press release that they had with respect to the liquidity changes. It is, I think, a mistake to confuse the zombie bank problem, and there clearly is a zombie bank problem with the Cajas and some of the Landesbanken, I guess, and now the Cypriot banks as well, we find out. There's clearly a huge problem there, and getting beyond that problem to a new regime is very, very serious. I mean, that new regime has to include things that probably can't be applied now. There's major debate with respect to the Cypriot banks, for example, about what to do about whether the wholesale deposit should be bailed in, et cetera, which is a very serious, difficult issue now. It doesn't necessarily tell you what the solution for the future would be. So I think we've got a huge problem. I think to say that it can be solved instantly or quickly is not convincing. Everything that we have seen the last 2 years, and that our at least economic research bears out, is that there has been a significant penalty to growth and to availability of credit, especially in Europe, as a result of the changes. Now, some of those changes are necessary, but there has been that penalty.
Yeah, I appreciate your taking this on. I just want to be sure that we're responsive to the questions asked rather than the general issue. Gentleman at the microphone, if you could identify yourself.
Sure. Peter Conti Brown from Stanford Law School. It's actually to exactly this point that I wanted to put another question. I thought one of the many compelling points of the book was walking through why this argument that there's a growth equity trade-off has superficial appeal, but at its base is fallacious. I wonder if you could talk about, both as a matter of economics and empiricism, how you get to the conclusion that there is a significant trade-off, and if you could talk about how you'd quantify that and say more about that conclusion.
I'm assuming from the
Mr.
way you're
Schraa,
phrasing
right.
the question, you're saying to Mr. Schraa.
And I'd be interested also for the other.
Then we'll let Anat come in after that. So.
Well, on the trade-off, first of all, I should again say my friend Phil Suttle, who's in Moscow at the moment, is one who should really answer that, our chief economist. But basically, the research that Phil and his group have done has shown that there, in fact, are trade-offs, that they have a more complex model of ROE and a required capital than I think the authors do. The required ROE that one would see now in the market today is quite different from a Modigliani-Miller ideal ROE. There's a lot of noise in the system. There's a lot of regulatory uncertainty. There's a lot of debate about, as has been said already, whether all the losses have been discovered. There's the intersection of the banking problems with the public problems, et cetera, et cetera. But I think the basic analysis, and by the way, the report from 2011 is available out here and online if you want it, is that there is a very substantial cost to GDP from reduced lending, which is set out in great detail and modeled in the paper, and that has been borne out as a matter of observation, as not theory, but observation in the last 2 years. And I think we'll probably be publishing something before too long that says that.
Great. Just again, for the record, just to be clear, we did invite Phil Suttle, and David graciously agreed to appear, and nothing against David, just to say that...
I'm a lawyer, I can't...
Yeah, no, exactly, that he's doing his best on that issue. Anat.
Okay, I just want to say the following. Lending is an investment, like other investments are made by other companies. There's nothing about how you fund investment that has stopped anybody in the economy from investing. Banks are not lending when they are in distress. That's when you get credit crunches. If they haven't lent in the last 2 years, it's because they haven't wanted to lend, or maybe they weren't loans, but They had their own reasons not to lend, and it's not capital that was the reason, because retained earnings and appropriately priced equity are there for the appropriate loans. In distress, the current equity holders do not want to lend because there isn't enough upside for them. They would be giving a gift to the creditors. This is a classic underinvestment problem of a debt overhang, just like the homeowner who's distressed will not invest in the windows, the same problem. So it's distress that causes lending constraints, not more equity. If banks retain their earnings, there would be no reason that they couldn't lend the money. I wonder how we could have reduced growth from retaining bank earnings. I have not been seen that. On Modigliani and Miller, we're not saying that equity is not expensive for banks. It is expensive for them. They don't like to use it. So there's no conflict on that. We are not saying that it doesn't matter. Matters to them in one way, matters to us in a different way. So that's the distinction there. I'll stop here to give much time for
That's a nice
comments.
tight thing. I want to let Morris come in, and then just so everybody knows they're being loved, we have John, the second gentleman at the mic, then Bill Klein, and then the third gentleman at the mic.
Just on this point about the macroeconomic effects of higher capital, Mr. Schraa is right. I mean, they do have a study, have had many studies ever since this issue came out. And they get much bigger estimates of the cost and the growth effects than do many other researchers, most of which, I might add, are not affiliated with the banking industry. That's a reality. If you go through the book, you will see the assumptions that are in these kinds of studies subjected to quite rigorous analysis. And you will find, at least I did, and I think many others have, you will find the type of analysis done at the IF wanting. These are not credible. I think that's my view. So I think that's important. To say you have a study and it shows large effects is fine, but the question is there are many studies, and which are the better quality ones? My view is the better quality ones show the cost of effects to be, if you find them at all, to be tiny, and certainly not large over a 2 to 3 year period. That's my view.
If I can respond to that, I think, first of all, there is a lot of argumentation. There are no numbers in this book. There's no data taken from the economy. There's no demonstration. I think if you look at our 2011 study, which you can put in scare quotes if you want, it does have a lot of numbers. It does have a good deal of academic apparatus. And if you did the same thing today, you would see that that study is closer to being on the mark than the BIS and a lot of other people were at that time.
Okay, we have a hot topic for actual analytic debate. That's a new project. Someone at the Institute will have to do a fair assessment.
That's a good idea.
John is next.
John Lipsky, Johns Hopkins Sites. I'm one who has not yet had the benefit of reading the book, look forward to it, but I just wanted to clarify a couple simple issues to see if I understand where you're coming from. The principal institutional response to the crisis was the creation of the G20 leaders process that posited as one of its 3 principal goals financial sector reform and mandated the creation of the FSB for the 2 purposes. One, to enhance systemic stability, and secondly, to enhance the level nature or level the playing field internationally. Is your point on the first that the plans currently being implemented do not enhance systemic stability, or that they don't go fast enough? In other words, is this an argument about how fast we're moving, or are you saying that actually what has been agreed will not enhance stability? And secondly, is it your impression that the measures that have already been, that are being put in place are enhancing the level nature of the playing field, or moving in the opposite direction and tending to ring fence individual markets and industries?
So I suggest
okay.
one of the authors respond.
Well, Martin would.
I'll begin on the second one. I'm not sure I really understood the first one. On level playing fields, we should realize that this is, by and large, a rhetorical figure of speech. And it's one that's being used, in fact, as a way of having a race to the bottom in the negotiations. Every participant in this debate has tried to maintain whatever feature of regulation has been comfortable for their system and tried not to give up on that. The argument I gave about this being the wrong way to approach it was an argument from the perspective of the national interest. Does this country, does my country, or any other country have an interest in making sure that their banks, quote unquote, succeed in global competition? And my answer to that would be the intrinsic interest must not be focused on the individual institution or the individual bank, but on the efficiency of resource allocation and on the protection of the system. Now, the level playing field dogma has also been used in order to allow for cross-border banking under the home country principle. And one issue that we have to worry about is, what does that actually mean? To what extent do we really think that that's an appropriate system? Because if you think about cross-border resolution, the big elephant in the room is the fact that if you have a major institution with subsidiaries in multiple countries, then subsidiaries, legally independent entities, then under the home country principle, resolution means each one of these has its own resolution authority in that country. Now, if legal independence goes along with operational integration, as it did, say, for cash management at Lehman Brothers, then the moment you trigger resolution, you break up the integrated operations. To be more concrete, the UK supervisors found that there was no cash when they entered the bank on Monday morning. So we have to come to terms with this. I mean, there are lots of things we can do about resolution, and that haven't been done except for the UK and the US. But no country, even the UK and the US, that have made the most progress has an answer on the question of cross-border resolution. And the issue of cross-border resolution raises the problem of cross-border burden sharing. If you have a single supervisor, which is what I would hope to get in the a single resolution authority, which is what I would hope to get in the European Union, there is still the question of who's going to foot the bill if there have to be bailouts. And I don't see the political system as getting there. So at that point, I'm wondering whether we shouldn't have another sort of second thoughts about the home country principle as a basis, and the level playing fields as justification or view that goes with this.
Okay, Martin, I'm
Get to
sorry.
the
No,
other
it's
question.
really helpful, but we have a lot of people, and we're
Sorry.
reaching our, no, it's fine, but we're reaching close to our witching hour. I'm willing to let this go a little long, but I just want to make sure other people get their voices in. So the gentleman at the mic, and then Bill Klein, let's start there.
Yes, Art Wilmarth, George Washington University Law School. Just a couple of quick observations. One is that we have a bit of a market observation in this country because community banks under $1 billion, even with deposit insurance, typically held capital well in excess of 10%, often 12 or 14%. And of course, we saw that some of those banks didn't survive. That gives us some indication about what market capital expectations might be if there were no subsidies. Now, the big banks always argued that they were superior at risk management. They didn't prove to be so during the crisis. In fact, Secretary Geithner said that, in his view, only one bank would have survived or not been at risk of failure in the United States among the big ones if there hadn't been the kind of TARP and capital assistance and liquidity assistance that was provided. My other observation is actually on prompt corrective action because Professor Goldstein, Dr. Goldstein referred to that prompt corrective action was supposed to solve this problem in 1991. Prompt corrective action has been applied with a vengeance to community banks. They've experienced the full brunt of it. It's done what it was supposed to do with them. But at the peak of the crisis in February 2009, our federal regulators announced that they would not apply prompt corrective action to any of the 19 largest banks. They exempted them, even though the statute gave them no authority to exempt anyone. So my concern is...
Can we get
yes,
to...
my concern is if we adopt what I think are very prudent higher capital requirements, do we actually think that regulators will have the will to apply them if it means, winding down a Citigroup or Bank of America?
Okay, thank you. Anat, do you want to say something? And Morris?
Just quickly on G20, just to say, we're not happy with the level of reform or with the speed of reform. We don't think it's safe, prudent enough. And sure enough, Art, yes, implementation is a huge, huge challenge, but we're in the hands of these regulators or we're kind of lost. So the only issue is pressure, I guess, or other ways to get them to do what they're supposed to do.
Very nice. Morris?
Well, just on prompt corrective action, I think if you had the kind of capital levels, equity levels that Anat and Martin are talking about, you would have a better chance of the various triggers applying because you're not, in fiducia, 2% is the level at which you close a bank, and if you don't have much above that, if you've got 30, you've got a lot, you've got a lot of play in there in terms of what you can do. You can suspend dividend. I mean, I think you're much more likely to have the PCA regime enforced with higher capital than you are with lower capital. The only other point I would just make, just to stress it, when David was speaking, he said, well, we support the capital and liquidity provisions of Basel III. The question is how far and how fast. That really is the issue of this meeting. We're so far apart. I would be very surprised if you could get the IIF to agree on a leverage requirement of 5%, much less 20 to 30. We're vastly different on that, and that ought not to be papered over. That's what this is about, this debate.
I think that's clear, but I appreciate Morris saying that. If you want to say something brief, David.
No, I think that's right, and I think that we would say that that's a very, very serious issue that the international community has to resolve. That we do need to look at the efficiency costs, not only of a huge capital increase, look at the efficiency and economic impact costs of getting to that increase, and nobody has said anything about how we actually get there in real life. And also with respect to the point about the G20, the G20 talked about internationally consistent regulation for global economic growth. And if you're talking about accepting fragmentation, regulatory fragmentation of the markets at a very great cost, additional cost to the cost of increasing capital, that in itself is going to create a huge cost and a huge drag on growth. Now, maybe you can come to the conclusion at the end of the day it's worth it because you don't have a crisis anymore. That's great if you believe that. I don't think there's been anything like a real demonstration that that's the effect. And we have a difference of view.
Okay. Bill?
I think
that's Bill Klein from the Peterson Institute.
The real challenge to me is to identify the socially optimal level of capital requirement. And from previous incarnations of this effort, my understanding was that your intellectual position was that there is no optimal level because the 1958 article of Modigliani and Miller proved that the reduction of the what you have to pay for your capital as a consequence. Okay, well, you're shaking your head. I've noticed that you seem very much to have backed away from this. In fact, David was the one who brought it up first. But let me add some, back of the envelope empirical information on this. As I understand Modigliani Miller, we should observe, if we look at the ratio of share earnings to price of the share on the left, on the vertical axis, there should be an unambiguous downward slope if we put the ratio of capital to assets on the horizontal axis. Because this is required for the M&M theory to say that it's okay if you increase your equity capital, you will be rewarded by a lower cost of capital. Lower cost of the equity is, of course, the earnings to price ratio. Well, for the United States and for the top 100 banks in the year 2012, that does not hold. It is literally a scatter. There is no negative slope. When I tried to trace back the evidence on the lower cost of capital to the reference to Jeremy Stein and Yaskin, the article that was cited in one of your earlier papers, Anat, when I tried to figure that out, they somehow were getting the cost of capital from the beta. Well, I don't think those are two commensurate at all. Now, Martin says there's a BIS study which shows that there's a lower cost of capital for banks with higher capital ratios, and that's fine. I look forward to seeing that, but to me, the intellectual underpinning of the whole approach is that there's a free lunch because you can put higher capital requirements on equity without having any effects on the amount of lending and activity. I mean, after all, we've got all this work by Levine and others, which shows a general positive relationship between credit deepening and growth. So I think that's what some of us have angst about. And I think there's a lot of sympathy for the notion that something above the current level has probably got a good social return. But there's a lot of angst that it might not be 30%, and what is to keep in your framework to go from going all the way to full reserve banking, 100%?
I think that'll be the day, Bill. But your intellectual point goes to the core of the issue. And since we're out of time, with apologies to the people who've been waiting patiently by the mic, I'm going to let Anat and or Martin respond to Bill on the core substance, and then we'll have to wrap it up.
Modigliani Miller is a result that just says that the only reason funding costs will change when you change funding mix is not because different securities have different returns, but because somehow the total that's available to everybody changes from the funding mix, such as more subsidies, more taxes, or some loss due to different investments being made, or any of that. So Modigliani Miller is not a predictive result, it's just a starting point of a discussion on the issues. I guess there is no time in this framework to go through the studies on the relationship, and more cited some of them, and there are many others. So we do cite studies. We are not saying that this result holds. We're saying that there are reasons for the banks to have a cheaper funding cost when they borrow more. We are only saying that the only reason for that is subsidies and a debt overhang effect from the perspective of their current decision makers. And that none of that is a social cost. What we're saying in terms of transition is, first and foremost, recognize zombies and close them. Secondly, retain earnings and ban payouts. And thirdly, raise equity at appropriate prices if it's possible. We don't need to inject more equity if the industry is shrinking. Overall, there could be less equity and smaller industry. The industry is probably too large, excess capacity. So we just think there's more natural shrinkage of the industry through capital requirements. And then we can see what else needs to be done.
Great. This very rich discussion. There's a lot of serious issues, including what Bill just raised. There's obviously a lot at stake here, which is exactly why we chose to bring this discussion to you. And we appreciate you all getting involved. For the third time, the book is The Banker's New Clothes by Anat Admati and Martin Hellwig. My gratitude to the authors, Simon Johnson, for putting us in connection with them, but also to our discussants, to Peter Fisher, to Morris Goldstein, and especially to David Schraa. Thank you all. This meeting is adjourned.